This podcast is sponsored by SoFi to help you get your money right and is for informational purposes only. Nothing in this program is a recommendation from SoFi to you or any listener. You should not rely on this program for any financial advice or legal or tax advice. The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates.
This is the important part. I'm Liz Thomas, head of investment strategy at SoFi. Hello, and welcome to the important part. Happy New Year, everybody. This is a special bonus pod episode. We've done this every year where I dive into my outlook by answering your questions. So first and foremost, thank you so much for sending in your questions via X and LinkedIn. We, again, got some amazing questions. We're going to cover a bunch of different topics, things like market liquidity, upcoming proposed policies from the incoming administration, currency moves, all things investing. So I'm super excited for this, as I usually am, and this usually ends up being one of our top episodes for the year. So I hope that you are excited too. And if it was your resolution for 2025 to get more involved in your investing lives, you have come to the right place. So now let's get to the important part. All right, so question number one, and this one I'm doing first because I think that this is a broad question that's on most investors' minds. Somebody put in, my main concern is liquidity coming out of markets, which invariably would hurt stocks. So the concern there, number one, I think, is about the idea that over the last couple of years, we've had a lot of liquidity in markets, despite the Fed having raised rates. But we did have that pause in the raising of rates, and now we've started cutting rates. But the concern being that maybe fiscal stimulus is going to slow down, some of the liquidity from the debt markets perhaps would slow down, and maybe that's been the big driver of stock returns up to this point. So what happens if that liquidity disappears? One of the conversations that has happened early this year, in fact, on one of the first days of the year, was that the debt ceiling needed to be raised again, meaning we met the debt ceiling, we met the limit that the government could borrow, and they couldn't borrow anymore unless that debt ceiling was raised. There were some concessions I'm not going to get into the weeds of that actually pushed that limit back to mid to late January. So we're still okay as far as the debt ceiling goes, but there's not really any clear path to whether or not they're going to raise it. And I would say there's also not a clear indication that Congress is going to be in any hurry to raise it. That said, it doesn't present a direct drain of liquidity because there's what's called the Treasury General Account. The Treasury General Account is basically what the Treasury has on hand in cash to support that liquidity. So what's going to happen is if there is a pause because the debt ceiling debate continues on, hasn't been solved, hasn't been raised, there will be liquidity that drains from the Treasury General Account, otherwise known as the TGA, if you've heard that acronym. And that will support government spending in the meantime. Right now, estimates suggest that that actually can support us through about midsummer. So there shouldn't be too much of a liquidity problem, at least in the first half of 2025. That's why we haven't heard as much about the debt ceiling being a problem yet. So the other thing I would say, though, the risk to this is that the longer it takes for the government to resolve the debt ceiling, the more of a problem there could be on the other side. So there is some incentive for them to figure this out sooner rather than later, but this is not something that's going to be a problem or that's expected to be a problem in January, February, March of this year. Speaking of liquidity and cash, a next question we got, and this one we got in a couple different ways, so I'm going to paraphrase a bit. It's basically revolving around dollar strength. So we've seen a pretty big rally in the dollar. Where's the top? Is there a key DXY price where you get really worried? DXY is the dollar index. That's the ticker for the dollar index. So that's what that question is about. Okay, so currently, today, as in before the market opened today, the DXY was trading at 108. It got as high as 109 recently. To put that in perspective, that's still below the 2022 peak of 114, okay? The other thing that's interesting about right now is that if you look at a measurement of dollar bullishness, so investors who are bullish on the dollar versus other currencies, it is right now in the 97th percentile, okay? That is high. That is an extreme measure. Bullishness being in the 97th percentile would suggest that we're probably at or near a top, barring any changes in the environment that are pretty major. What are those changes that could happen? So we know that tariffs have been a pretty big conversation. If tariff actions end up being more aggressive than what the market is pricing right now, you could see further upside in the dollar. You could see further upside in yields. We've seen a pretty strong climb in the 10-year yield as well. If tariff actions are not as strong as what the market has priced right now, then we're probably at or near a top in the dollar at this point. But we won't know that. And that's kind of the awkward part of this period right now. We're in this waiting game. We won't know that until post-inauguration, post cabinet members being confirmed, and when we have more clarity on what those policies will be. We've heard things about what the proposed policies are. We even heard things as early as yesterday about what the proposed policies are, but none of those are actually in place yet. So we need clarity on what's actually going to happen with tariffs and whether or not the market is priced appropriately for that right now. And then the last thing I'll say about the dollar strength on its own or in and of itself is slightly less important than why it's actually gone up. So if it's strong and if it's strengthening because yields have gone up, then you're going to see likely more pressure on stocks. You're going to see likely more pressure on markets. Because if yields are going up at the same time as the dollar is going up, you've got pressure on valuations, and valuations stop looking as attractive. If it's strengthening or strong because of trade wars, the implications get much less clear. Sometimes that might be a good thing. Other times that might be a bad thing. And always remember, the dollar tends to be the safe haven currency for the entire globe. So sometimes the dollar is rising because there's more fear in the markets. So you have to pay close attention to why it's happening more so than the actual level of the dollar, which is why I'm not answering that question directly to say there's, at this particular level, I think we have a problem. And I want to reiterate, where we're trading today is still below the 2022 peak. And that 2022 peak happened shortly after inflation peaked and in the midst of a Fed hiking cycle. So we're in a different environment today. And I think that likely keeps a little bit of a lid on this dollar strength. All right, question number 3. I love this one. What is your stance on gold and gold mining stocks? Anybody who's been following me for the better part of a year knows that I have talked about gold a lot. So, all right. We just covered a question on the dollar. Recent strength in the dollar has definitely put pressure on gold as a commodity, and you can trade that a number of different ways. There are a number of different ETFs that track gold. You can also look at it as the commodity itself. So recent dollar strength has definitely put pressure on gold. That is usually an inverse relationship, meaning as the dollar strengthens, you see gold weaken. And that is what's been happening lately. In turn, that's put pressure on gold mining stocks. There are also ETFs out there that you can use to track gold mining stocks. Before the pullback, gold had done really well. In fact, through most of 2024, gold was outperforming the S&P 500. Until later in the year when we saw this post-election surge in the S&P and a give back in those gold prices. But up until the election, gold was actually doing better than stocks, which is a rare occurrence. And it was something that we needed to sort of heed the message of. I won't say the warning of, but the message of. The message being, for some reason, there is demand for this safe haven asset, this so-called store of value. And it's been more demand and stronger demand than we've seen in most years. So I still view gold as a really good portfolio diversifier against both geopolitical and currency risks, and just against some of this concentrated equity performance that we've seen in growth stocks. So this is one of those times that if you have held gold, if you have exposure to gold in your portfolio, it might be a line item on your statement that you're looking at and saying, why am I still in this? Why is there a big pullback? I need to get out, perhaps. If it's giving you some butterflies in your stomach, I would remind you that it's not all supposed to go up at the same time. And in fact, if it's not all going up at the same time, that likely means that you are diversified. So if you've got other parts of your portfolio that are exposed to, for example, mega cap stocks that have done well since early December, and then you've got gold in there that hasn't done so well, that's what diversification should do. Now, there should be other asset classes in there, of course, as well, but don't be scared away just because of a near-term pullback. The second point on gold is that there's been a lot of institutional and central bank appetite for gold. So this hasn't been a trade that a lot of retail investors have been a part of. So mostly, and we'll talk about China in a minute, mostly the Chinese central bank has been a big buyer of gold. I won't get too far into why that might be, but there has been consternation or at least some trepidation around the globe about having control over your own currency as a central bank. And we know what happened with Russia when sanctions were put onto Russia. There was this sort of weaponization of currency that occurred, and a central bank and a government didn't have free access to its own currency. So other central banks noted that, said, okay, we saw that. We saw what happened there. We don't want to end up in that same position. So what do we need to do to protect ourselves from that? How do we make sure that we have reserves that are still accessible no matter the geopolitical risk? Gold is one of those things. So we've seen a ton of buying from central banks, particularly the Chinese central bank. Why that matters is because that's what's propped up the gold price. I don't think that appetite is going anywhere. I think, in fact, that appetite could get stronger if currency volatility picks up again. Now, the other thing is retail investors have noticed that has supported the gold price. And there are ways to invest in gold as a retail investor. So you could now see a surge in retail participation, which supports that price further. Any sniff of risk that comes into the market, any fear, any risk off behavior, gold is likely to do well in that environment as well. So I think it's something that, although it's had a weak spot, still a good diversifier. I still think that there's good demand for it. And I do still see gold as a good opportunity in 2025. Okay, question number 4. I've heard a lot about elevated valuations in both the S&P 500 and NASDAQ 100. The NASDAQ 100 is the 100 largest stocks in the NASDAQ, with the latter being comparable to tech levels in late 99. Do you believe that underlying fundamentals are sufficiently different this time to continue to support even at these levels? Do you believe those indices have room to increase in 2025? Let's start with the dot-com bubble. So this 1999 period that the air came out of the balloon for much of 2001, 2002. We'll start there just to answer the question of, do we believe the fundamentals are actually different this time? So during that period, a lot of the companies that were doing well didn't have much as far as revenue or profit or cash flow. There wasn't a lot of tangible result happening from that. And we all know that the enthusiasm around it was about the internet, that the internet was going to be this transformational technology, it was going to be a total game changer for most industries. And we were sort of choosing the winners of who was going to be the best company positioned to benefit from the internet coming on board. The internet absolutely did turn out to be a game changer, absolutely did transform many, many industries, if not every sector in the S&P 500. But it didn't happen for about 10 to 15 years. It took 10 to 15 years for us to figure out what all of those benefits were. And what I would say about companies today, so many of the companies, the mega caps today, that are benefiting from this AI theme, they were already some of the largest companies in the world. And they already had strong margins. They already had cash flows. They already had defensible revenue streams. So this AI piece is additional. The fundamental story is different today than it was in 99 for that reason. So these companies are not just predicated on an idea. They already existed before and they had tangible results. The part that may not be so different is what I mentioned before about this enthusiasm. So there was enthusiasm about the internet. There is obviously enthusiasm about AI and the expectation that AI will transform many, many industries. That may very well be true. And in fact, I do think that AI will be a transformational technology. I do think that it will be innovative for many, many industries. We're starting to see some of the early ways that it's going to be profitable, but just starting. Where it could be similar is that enthusiasm and what we would call the pull forward effect. So the idea that, yes, there's this expectation that AI is going to change a lot of things, but we pull forward that expectation in the market and price it today, which is what you're seeing in a lot of those stock prices. So that could be similar to what happened. And again, I'll remind you, it took us about 10 to 15 years to figure out all the different ways that the internet would be profitable for companies. So that's not to say that it wasn't profitable. It was absolutely profitable, but it took us a long time to get there. And many of those early winners in that internet theme were not the companies that prevailed over that entire period. So there are likely to be fits and starts in this theme. There are likely to be changes in how we use AI. And there are also likely to be a lot of changes in the companies that are actually going to benefit. So that's where I think the similarities come in. The last thing I'll say on this, and this is a little bit more of a broad answer to the part of the question that was, do you believe those indices have room to increase in 2025? I'm just going to answer this for the S&P 500 because it's a much broader index, but is still heavily influenced by those Meg 7 and mega cap companies. So if earnings growth comes in line with expectations, and then let's say we keep valuations, so the PE multiple, the forward PE multiple, let's say we keep it exactly where it is today, meaning no real multiple expansion. So we'll keep it at 21.9 times. If earnings expectations come in as expected, that would suggest the S&P at a level of 66.35 by the end of this year. That is not my price target. Let me be clear. I don't have price targets, but that's what that math would say. So we leave the PE at 21.9 times, and then earnings expectations at about 303. That would suggest an S&P at 66.35, which would be a gain of 11% for the year. 11% is right around average for the S&P annual return. I think that we can be happy with that after 2 years of 23, 24% upside. So the answer to, do I believe there's more room for upside in these indices? Yes, but probably not to the magnitude that we saw in 2023 and 2024, especially because much of that was driven by these large cap stocks and was driven by the enthusiasm and the pull forward effect of the AI theme. The next question is similar, but we're going to dig deeper here into the Meg 7. So do you think the Meg 7 will continue to perform well in 2025? I even want to broaden this out. We all know what the Meg 7 is. I would say maybe the top 10 stocks right now in the S&P are the ones that are important to watch. So that goes on to encompass a few more. But basically, we're still talking about mega cap and either tech or tech adjacent type names. So do I think they can still perform well and even maybe outperform in 2025? In the second half of 2024, investors started to get impatient with basically where's the return on investment for all of this spending that's happened on AI. And there's been a lot of capex by a lot of these companies, and they were rewarded for that in the market. So you come out during an earnings season or otherwise, maybe between earnings, and say, we're investing X amount of dollars into AI in order to capture this theme. Companies were rewarded for that spending for a decent part of 2024, the first half of 2024, and in 2023. In the second half of 2024, it started to be like, okay, you've spent a lot of money. Now show me the return. Show me the tangible results. Show me the revenue. Show me the profit margin. Show me all of the things that I can now benefit from as an investor in my return on equity or my ROI. So investors did start to scrutinize that more. I think that will continue in 2025. So then it hinges on, are these companies able to actually show tangible profit? Are they able to actually show innovation that has improved productivity, improved their margins, raised their revenues, raised their profit margin, all of this? If they're able to show that, then yes, I do think they can still perform well, perhaps outperform. And you do have tech this year expected to have higher earnings growth than other sectors. But if they're not able to show that as much as investors are expecting, they may not be, again, the standouts that happened for the last 2 years. Now, that doesn't mean that they have to have this huge pullback, but they may not be the standouts. And I think that investors will start to look in other places for growth. Also, this is coming after a period of what we had, which was broadening out in the index. So other sectors started to take part. It wasn't just a tech game anymore. We had small caps do really well. We had other more, what I would call old economy sectors do well. So industrials did really well. Financials were doing really well. So we had this broadening out that sort of dissipated towards the end of 2024. And so far in 2025, it's been here and there. But what I would say about this is, I don't think we want the Meg 7 to be the standout performers again, because what it does is it creates this growing, widening gap between winners and losers, where you've got really concentrated market performance. So the overall headline says the S&P 500 is doing well, the NASDAQ 100 is doing well, but when you dig down, it's really still only a few stocks. The bigger that gap gets, the bigger the divergence grows, the more fragile that market is. So I would argue we want the broadening out to come back. We don't want another year of full standout Meg 7 and mega cap performance. Next question. This is question number 6. This is a topic usually near and dear to my heart, although it has been one of great frustration over the last few years. What are your thoughts on small caps for 2025 and any risks you foresee that can derail everything? I would urge, first of all, people to go and read the outlook that we put out for 2025, because we very clearly outline 3 big risks. Basically, where could this go wrong? This isn't just for small caps, this is for the entire market and economy. Where could this go wrong? Those are the 3 big risks that we outline. So the first of which is sentiment gets overextended. That's a real risk to the market because we got so high in sentiment. There was so much bullishness that happened post-election. So if it gets overextended, that's where you start to hear the word exuberance come in. And then you have to have this repricing to bring things back down to earth. So that would be one of the first risks. The other big risk is that inflation reignites to a point that's uncomfortable. The Fed has to turn hawkish because of it. Yields maybe spike in response to all of that. That would be another big risk that would really threaten market dynamics in the near term and the medium term. And then the last big risk is that the AI theme fails to really materialize in earnings. So I just did a really long answer on that, basically just saying that if these companies that have seen such a big run up in price don't show tangible results, can't give investors what they're expecting, then you've got more air that comes out of that AI balloon, at least in the near term. Okay, so small caps in particular, much of the recent bump in sentiment has been predicated on an incoming administration and policies that would reduce regulations, rein in government spending, encourage stronger economic growth, all of which should be positive for small cap stocks. So that's why we saw a big surge in small caps post-election. Much of that has been given back. And small caps have still struggled to get what I would say off the mat. They haven't been able to have a breakout. They haven't been able to hold on to the rallies that we've seen over time. Some of the other asset classes that have benefited from that expectation are financials, consumer discretionary, and crypto. So you've seen big run-ups in those since the election took place. The big risk here is that if those policies don't actually come to fruition, or at least don't come to fruition in the same way or with the same strength and fervor that the market has priced in, then we do have to reprice that. We do have to reprice that opportunity. And that is particularly a risk to small caps, which has perhaps already started to happen. Now, I mentioned before, we're in this waiting game. This will remain that way until we have more clarity. And the earliest that we're going to have clarity on some of these policies is probably February, more likely later than that. Even more so later than February, later than the first half of this year. So you may have to wait until the second half of this year to say, okay, now some of this has actually made its way through Congress. Now we know how to set our own expectations for how this might affect markets and businesses going forward. But I don't think that we can expect clarity immediately as soon as this administration takes over. One of the things that is positive for small cap companies is that when you look at just the revenue mix of small caps, most revenue of smaller companies comes from domestic sources. So in the event of continued trade disputes, disruptions to supply and demand because of trade, small cap companies are insulated more so than large cap companies from that volatility. So that could be something that helps small caps in the near term. Something that works against small caps in the near term is rising rates. So when we've got, and I don't mean the Fed funds rate, I mean yields. So when we've got yields that are going up, small cap companies tend to suffer more in environments like that because they are more susceptible to borrowing. So as borrowing stays tight and as the cost of borrowing stays high, small cap companies tend to suffer more. All right, we're getting close. We're getting close to the end. This was a big question, a big picture question. Will the Fed be forced to radically lower rates by a sharp downturn in the economy, even though inflation is rising at the same time? So I think really the crux of that question is, if stagflation occurs, will the Fed have to lower rates because of that, even if inflation is still a problem? My short answer to that is no, but I want to be clear. If there is a sharp downturn in the economy, I'm not talking about a sharp downturn in the market, okay? A sharp downturn in the market itself, unless caused by some exogenous shock that will affect the economy or something that is threatening the functioning of financial markets at large, a drawback in the market, a correction, is not going to cause the Fed to lower rates further. If there is a sharp downturn in the economy, inflation is unlikely to rise. So inflation will be affected by lower demand. It will likely be affected by higher unemployment, the fact that we're going to see unemployment go up, you're going to see fewer jobs added, which would bring wage growth down as well. And companies would probably hold off or reduce their CapEx spending, still bringing demand down in both the private sector and the consumer sector. Housing would probably start trending down. So you're unlikely to see inflation keep rising if there is a sharp downturn in the economy. The exception to that is if there is some shock in the commodity market. Okay. So you could see demand in the economy from consumers and businesses come down, but then a shock to, for example, energy prices. But the question here was, will the Fed have to lower rates, even if inflation is rising? Hang with me here. This is a little bit more of a complicated answer. The Fed is looking at inflation typically X energy, okay? X food and energy. But let's talk about energy for a second. If there is a big rise in energy prices that drives inflation higher, we have to be talking about headline inflation. The reason the Fed starts to look at things like core, which takes out food and energy, is because of those possibilities. They don't want to have to make monetary policy decisions based on a short-term rise or a short-term shock to something like the energy market. So even if headline inflation is going up, which includes energy, even if headline inflation is going up because of a shock to the energy market, if there's a sharp downturn in the economy, chances are that many of the other components of inflation are actually coming down. So in this scenario, now, would the Fed lower rates if there was a sharp downturn in the economy? Absolutely. But would they be handicapped because inflation was still rising? Probably not. Inflation would likely be falling in that scenario. Next question is on Chinese equities. I promised we would talk about China here. So the question is, thoughts on Chinese equities? I'm thinking time to load up in anticipation of a stimulus bazooka, regardless of what Trump does. So if you read that outlook, you will find that when we talk about what catches our eye in 2025, we list off some of the asset classes that seem interesting to us in 2025. China is one of them. And China is very much a contrarian play right now because they have been suffering and because it has been very well telegraphed that the incoming administration plans to limit China's trade with the US and sort of tighten the screws even further than we already have. But this is an area that I think much of the bad news is priced in. Now, they've seen further downside over the last few weeks. So maybe not all of the bad news is priced in, but I think a lot of it is. What's happening in China right now, we've got a Chinese consumer that's struggling. We have a Chinese property market that's struggling. We have China in general in a deflationary downturn. We have a Chinese currency that's weakening. China barely getting to its growth targets. And rest assured, that is not a state that the Chinese government is comfortable with and not a state that the People's Bank of China is comfortable with. So there has been some attempt to announce stimulus. There had been in 2024 a couple times. They did announce stimulus. It so far has not convinced markets to hold on to any rallies. I believe in 2025 they will continue to announce stimulus because it hasn't worked yet. And there are parts of the economy, as I mentioned, the consumer and the property market in particular, that have not really been targeted yet. So they've targeted the stock market. They've made some changes to try to boost demand, but it hasn't really worked and had any staying power yet in markets and in the economy. So I believe they will continue to announce stimulus until it starts working. And a couple of those places, if they start to announce stimulus that does directly target the consumer and that does directly support their property and real estate market, I think there starts to be upside in Chinese equities. This is, again, a contrarian play. It's a risky play. It's not something that I would put a vast majority of my portfolio in. So I would say when you're looking at this, if it's something that's interesting to you, it's something to do on the periphery of the portfolio. But I do think that there could be an opportunity here in 2025. Lastly, certainly not least, The question is, what would be your 3 most favored sectors to overweight in a portfolio? You can also find some of this in the What Catches Our Eye in 2025 in the Outlook. If I had to pick 3, I would say healthcare, materials, and financials. And then I'm going to add, don't sleep on energy or industrials. So what you'll notice in there, I think glaringly missing, is tech. It's not that I don't think tech is a good place to be. In fact, I do find software a good opportunity for 2025. But if we're talking about broad sectors, and if I had to choose favorites, pick my favorite children, I would say healthcare, materials, and financials. So starting with healthcare had a rough 2024. Okay, so it's coming into 2025 as a laggard. And it's coming into 2025 with the expectation that policy will not be friendly. So much like China, I think a lot of the bad news is priced in here. And if you've got investors looking for other ways to find growth in the market, a lot of times pharma and biotech tend to be beneficiaries of that. So if you have people rotating out of tech, either because they are ready to take some gains or because we've had a little slowdown in the enthusiasm, I don't think people are going to be ready to come out of the equity market yet, but they're going to be looking for other opportunities, and healthcare could be a beneficiary of that. Not to mention, when we think about the fundamentals of the market in 2025, so the earnings growth in 2025, which I think is going to be a critical factor for what performs well, healthcare is actually expected to be the second strongest sector in the entire S&P 500. And that was not the case last year. So tech is still expected to lead the pack as far as earnings growth goes. Healthcare is expected to be number 2. And then also up there on that list is materials. So you want to look for those little opportunities where maybe there's a reversal in what happened in 2024. So maybe earnings growth was not very strong in 2024, it's expected to be much stronger in 2025, coupled with much more attractive valuations, maybe a better entry point than some of these stocks that are trading at all-time highs and have seen much of that pull forward effect in enthusiasm. Secondly, materials. This would encompass some of that gold trade. But if this is an environment where inflation is sticky and perhaps reigniting a little bit, and we've got a pro-cyclical, pro-growth environment in 2025, if that comes to fruition from policy, then materials is something that should do well. They've had a rough go of it over the last few months. So again, this could be something that's trading at an attractive valuation. Financials, I think this is probably the worst kept secret. Financials have done well since the election. So this is not something that hasn't seen a rally. There has been quite a rally in financials. But again, if those policies come to fruition and we've got lower regulations, financials continue to benefit from that. The other side of financials that could be a tailwind is this expectation of a pickup in mergers and acquisitions that could happen in 2025. Financials are a part of that transaction, regardless of which industry it's taking place in, and just a pickup in capital markets activity that also could benefit financials. So that goes to show it doesn't have to just be banks. Financials are not just banks. It can be a lot of other financials that benefit from that as well. And then again, don't sleep on energy or industrials. There's been some growth in energy prices. Industrials had done really well in 2024. They've given a bit back, and they're at a point where we need to see them come back and inflect higher again to support this cyclical attitude in markets. But those are two that could do well. Broadly, again, old economy stuff that we're talking about here. So if investors are looking for growth in other places than tech, you could see some of these sectors really benefit. Okay. That's it. That's the Q&A to start off the year. I hope that everybody who put questions in either got the answer they needed. There are a couple that I didn't get to in the interest of time, so we will try to get to everything that we can either in the next half of 2025 or in our next Outlook. So thank you again for everything that you have submitted. I hope that was helpful. I'm excited for this year. I'm always a little bit nervous, but that's just how it goes as investors. We have to always be aware of the risks, but excited about the opportunities as well. So here's to a prosperous investing year ahead. For more from me, read my weekly column every Thursday on the SoFi blog or follow me on X at Liz Thomas Strat. Follow The Important Part wherever you get your podcasts. The Important Part is produced by SoFi in partnership with Pod People.
This episode of The Important Part was recorded on January 7th, 2025. The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates. This program should not be copied, distributed, published, or reproduced in whole or in part or disclosed by any recipient to any other person without the express written consent of SoFi. Each name of any organization mentioned in this program is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any authority, ownership, or license rights between any such company and SoFi. The content of this program is not a recommendation from SoFi to you or any listener or recipient of this program, and is provided for informational purposes only. SoFi is not providing any financial, economic, legal, investment, accounting, or tax advice through this program, or to its recipient, and you and any person should not rely on this program for any advice. Investment decisions should be based on specific financial needs, goals, and risk appetite. SoFi has no obligation to provide updates or changes to the information in this program. Past performance of any investments mentioned does not guarantee future results, which may vary. Neither SoFi nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information contained in this program. Any liability for any statements in this program is expressly disclaimed by SoFi. For additional disclosures related to the SoFi Invest platforms described above, please visit sofi.com/legal.